I am very grateful for the Bank of Lithuania for bringing me over here. I always wanted to come to Vilnius, and I've been looking for an excuse to come, and finally I got one. And of course, being from Iceland, I brought the snow with me. By the way, even though I do think I confused your statistics for the number of foreigners, because I have 2 passports. But I came from London here. Now, my topic today is real estate, and the more I thought about it, the more fascinating I found the question. Real estate is many things. It's a driver of crisis, it's a driver of wealth creation, it's a driver of economic growth, it's a fundamental part of savings, including pensions in many countries, and it's a source of growing inequality, perhaps the most serious consequence of what's been happening in the past 10 years. I think it's certainly the most political of all macroprudential domains. Now, so that sort of gave me a very interesting topic to talk about for the next 30 minutes. I'm going to tell you what I'm not going to talk about. Since we have so many policymakers, and I've seen the slides of several, the policymakers will talk about specific tools and how they are implemented. So I decided to avoid the discussion of specific tools and do a slightly broader discussion of how real estate could fit into the wide macroprudential domain. Now, to start with, what is the objective of macroprudential policy? And now, it's one of these things, if you ask 10 people, you will get 10 answers. But my answer is, since I lecture on this in LSE, I have to come up with a concise definition. And my definition is that MacroPru has 3 objectives: preventing the excessive accumulation of risk in the financial system, to contain financial crises when they happen. And by the way, be sure crises will happen. You cannot prevent them, nor should you prevent them. And finally, ensure that the financial system efficiently comes to economic growth. And we tend to often forget the last one, but the last one is perhaps the most important. Now, in order to be effective, a macroprudential authority needs several things. This comes from a piece we did a few months ago. The macroprudential authority needs to have estimates of risk in the system, systemic risk, how risk impacts on the real economy, and this has to be across the entire cycle, from the very earliest signs of buildup of risks until the consequences of crisis resolution, what happens afterwards. The policy authority needs effective tools to deal with and implement macroprudential policy. And perhaps most importantly, what is least discussed, it needs legitimacy, it needs a reputation for being impartial, and it needs political support. And it's in the last bit where I think real estate becomes especially important. Now, if you want to implement macroprudential policy, we can take 2 directions. We can have passive macroprudential policy, dealing with crisis and fixed rules that hold through the cycles. Now, I'm a sufficient MacroPru geek. I have a favorite MacroPru rule, and my favorite rule is what was implemented by the SEC in 1933, which is banning buying stocks on the margin. That's been a fantastically efficient, good rules and served the United States well. As a good example of how to properly do MacroPru. The more ambitious, or we could call it discretionary MacroPru, is leaning against the wind. So you become more active. There you need discretion from deviating from rules. We need to tighten capital and liquidity requirements during upswings, relaxing them when the time is right. We need to cut through the amplifying feedback loops that are at the heart of every crisis in the system. And discretionary MacroPru aims to be explicitly countercyclical. And of course, if it is successful, it is of considerable benefit. And I think, in a way, the theme of this conference is discretionary or activist MacroPru, is it effectively countercyclical? And here's the promise. This is one year of economic growth created by me in the computer, on average 3%, but with cycles. And the promise of MacroPru is to give you steady, higher growth. So I'm going from fluctuating 3% to fluctuating 4%. It is not all that useful if you just end up with steady 3% growth. It might be slightly better, but the danger is you will end up with a steady 2% growth. So I think one needs to always keep in mind how do the MacroPru tools we have link to very long-term economic growth, and we need to think decades or multiple decades in that. Now, if you think about what is the cause of risk or what drives risk, there's a considerable lag between a crisis happening and decisions that lead to the crisis. Now, crisis in 2008 did not happen because of anything anybody did wrong in 2008. The crisis in 2008 happened because of decisions made, say, 5 years earlier in 2003. In 2003, all signs pointed to risk being low. Both the financial authorities and the private sector thought everybody was safe. It was perfectly okay to take more risk. As Hyman Minsky said 25 years ago, stability is destabilizing, because if you are successful in keeping the financial system stable and safe, that endogenously incentivizes people to take more risk, which then will lead to a crisis. So too much stability cannot be a good policy objective either. Now, it matters what sort of event we are talking about. If the stock market in the United States goes down by $200 billion this afternoon, nobody cares. It happens once or twice a year on average. It's a loss everybody's prepared for. The potential losses from subprime in the U.S. in 2008 were less than $200 billion in a worst-case scenario, and it almost felt like the world came to an end. So the same loss in one context passes for the ripple in the system. In a different context, the same loss has enormously disruptive consequences. Now, it is the risk that if risk we know about, the known knowns, to quote Donald Rumsfeld, is least important. Because risk we know about, that's the risk we prepare for, like the stock market. It's the risk we don't know about that's the most dangerous. It's the unknown unknowns that are really the most dangerous. The unknown unknowns in 2008 was the packaging of subprime into structured credit products. So, of course, if the next crisis will not happen in the known domains, it will happen when nobody is looking. And that, of course, is the fundamental challenge to every macroprudential policymaker. Financial risk is created by the interaction of the economic agents that make up the system. Some 15 years ago, me and some colleagues, we classified risk into two categories, what we call endogenous and exogenous risk. Exogenous risk is the risk that is the view that risk arrives to the system, people react to it but don't influence it. Endogenous risk is the risk that's created by market participants themselves. Now, in a way, this is partly motivated by the former head of the BIS, Andrew Crockett, and this is one of my favorite quotes on financial stability, and I'm going to read it out to you. So he wrote, "The received wisdom is that risk increases in recessions and falls in booms. In contrast, it may be more helpful to think of risk as increasing during upswings, as imbalances build up, and materializing in recessions." And it's that phrasing that fundamentally drives effective, or recognition of this, that fundamentally drives effective macroprudential policy making. Market participants are guided by a large number of models and rules, and many of them dictate myopia. There's a surprising consequences of rulemaking is that the more you try to control behavior in the financial system, the more short-term you make people. And you can, in the extreme is, you converge behavior horizons to one day. And that, of course, means that constraints only bind in the worst states of nature. And because endogenous risk is created by the interaction of human beings, all with their own objectives, abilities, resources, and biases, and of course, this means that most attempts at measuring risk get it wrong. We overestimate risk when things are bad, and we underestimate risk when things are good. We are systematically biased in measurements. Financial risk has two phases in our view. Perceived risk and actual risk. Perceived risk is the risk that you measure. We sometimes use the term riskometer as a measuring device used to capture risk in the financial system. Actual risk is the unknown unknowns, is the monster hiding the bed. It's really what makes things go wrong, but we can't measure. Here is a typical bubble in markets, real estate or equity or other asset markets. You say you go up the escalator and down the lift. You go up at a faster and faster and faster rate, then at some point something happens and the markets collapse. I've seen a lot of bubbles and they all look like this in some way. If you measure risk across the cycle, your risk measurements tend to fall before the bubble bursts. And because this is the way this is mechanically how the measuring devices work. And it's almost like in the 1980s song, Money for Nothing. It's a fantastic period to be in the market because you are investing, risk is low, and returns are high. All of a sudden, things go wrong and everything bursts. When the bubble bursts, measured risk goes up. Actual risk is the opposite. It's negatively correlated. It increases with the bubble and falls after the bubble. So one should aim to measure actual risk, and there are ways one can get at that. Now, connected to that is how often do systemic crises happen? If you ask the IMF World Bank database, a systemic or serious financial crisis happens in an OECD country once every 43 years. That should be the appropriate target rate. So if you see a macroprudential policy that targets once a year or twice a year event, then the policy rule is disconnected with the crisis frequency. So we should always keep in mind once every 43 years. So this is what I call the 43-year cycle of crisis. Early 2000s, systemic actual risk builds up. All of a sudden, we hit a trigger. The crisis happens, late 2008. That's when perceived risk goes up. That's when we get improvised responses. We get MacroPru implemented. Meanwhile, over time, the rules ossify because the market just takes the rules, figures out how to do regulatory arbitrage, and the cycle repeats. Perceived risk measured across the cycle peaks soon after the crisis period. Actual risk peaks before the crisis and starts picking up towards the end of the cycle. So again, the challenge for the policymaker is to measure actual risk. Now, this is theory. Quick connection to empirics on this. So with some co-authors, we got interested in the connection between volatility and crisis, and Janet Yellen said 3 years ago, volatility in markets at the low levels, both actual and expected, to the extent that low levels of volatility may induce risk-taking, is a concern to us. We got curious, and we empirically tested this. What happens is that in a 5 to 10 year cycle, you start with volatility being low, that then increases appetite for risk, that then increases demand and supply of credit, that then leads to defaults, that then leads to banking crisis, and high volatility is correlated with crisis but does not predict them. So if a measuring device targets volatility, you just end up targeting the likelihood of a crisis. And we empirically tested this with a very extensive database of countries going back to the year 1800 in some cases. There's a very strong empirical evidence for low volatility predicting crisis 5 to 10 years into the future. High volatility does not predict a financial crisis. So that gives us some idea of how to start measuring the actual risk in the system. Now, connect this to MacroPru, the topic of this conference. It is extraordinary how much power we give to central banks in a democratic society. If you think about this, Janet Yellen has more power than the Joint Chief of Staffs, even if the Joint Chief of Staffs has nuclear weapons, because Janet Yellen reports to nobody. The Joint Chief of Staff reports to the President. So why do you give an unelected bureaucrat and institution connected to this person all this power? Well, the reason, of course, is it's the only way we can get stable monetary policy. We know from bitter history that politicians can't be trusted. But I think always keep in mind, this is a lot of power and faith to give to an unelected entity. But monetary policy is straightforward. There's one measurement, inflation. There are two tools, price and quantity of money, clear objective, clear target, and clear tools. MacroPru is complex and ill-defined. If you, like I say, you can go to the various websites of the policy authorities, they'll give you very conflicting definitions of MacroPru. Indicators are in price and conflicting. On my last count, the ECB had mentioned 50 indicators for systemic risk on the website, and they will, at any point in time, indicate in various directions. The surgical tools are blunt and ineffective. Surgical tools are ineffective often, and the powerful tools are too blunt. And finally, MacroPru identifies clear winners and clear losers, which creates which affects politics and lobbying. Now, we should keep the politics in mind. Very few stress events in financial systems arise purely from excessive risk. I can actually only think of one. Most big stress events are highly influenced by politics. In extremist wars, Venezuela is purely political. Transition between political systems, or populism or anti-globalism, as you see in Europe today, or even government policies promoting home ownership in times of a real estate bubble. In those cases, MacroPru or MacroPru event, whatever that is only a consequence of a much bigger chain of events. So we need to see the financial consequences in the broader context of what's happening in the political, economic environment. Now, this leads to the dilemma of political risk. Can a non-political entity, like a central bank, legitimately implement MacroPru policies that affect democratic outcomes? When Bank of England tried it, they started opining on Brexit, and it got so bad that the governor of the Bank of England was attacked by the Prime Minister. Governor then went on TV basically saying, "Can I please get political support?" And the Prime Minister had to say, "We like this Bank of England and the governor." If you think about it, that's an unprecedented need for validation from the political leadership. That only happened because they got involved in politics. Does the mandate given by the political leadership to the regulator extend to the behavior of the political leadership itself? Not really. But are MacroPru authorities, if they're not able to incorporate political risk in their frameworks, how effective can MacroPru be, and how legitimate can they be? And I think this is perhaps the fundamental challenge to implementing macroprudential policies, is how to deal with the political dimension. Now, a few months ago, I saw an interesting presentation from a political scientist on the ability to execute MacroPru. And in that study, they had done studies comparing as a dependent variable, the faith in the government and degrees of democracy. And basically the conclusion is, if you have low faith in government, it is very difficult to effectively implement policy because people do not trust the government. So that means if you're a dictatorship, you can, but a democracy with low faith in government has very limited ability to execute reforms. And you can just think of the one European country where that applies to. And by their own contrast, some countries, the government is able to announce bad news, say, this is difficult, but you have to do it, and population believes it because they trust the government. So we have to connect the ability to execute MacroPru also with the reputation of the government and the population's trust in the government. Otherwise, the effectiveness depends on those variables. And similarly, MacroPru can be pro-cyclical, which is perhaps slightly ironic. First is the argument by Minsky, as I said earlier, stability is destabilizing. If you're successful in stabilizing the system, that endogenously encourages risk-taking behavior. If the policies aims to homogenize the financial system, as we are now seeing with increasingly Basel-style regulations applied to both asset managers and insurance companies. That also homogenizes. And similarly, a lot of indicators of risk only identify perceived risk. You react to a lag with an indicator measured with a lag. So that gives considerable scope for out-of-cycle response or pro-cyclical policy response. And here's one example I got from the ECB website, which is the ECB systemic stress composite indicator. And you can see not only is it highly correlated with the S&P 500 volatility, but equally importantly, it's lowest right before the crisis. And that tells us that that's exactly the signal you get in 2006 from the ECB composite stress indicator, everything is fine. And that is exactly, so it's missing out on the actual risk. Similarly, it's affected by transparency. If a MacroPru policy is known to the market, the banks will simply schedule risk-taking around the indicators, stress test, and policy reaction. You can game this. You can game the policy if it's transparent, and if it's not transparent, then it will not be legitimate. And finally, policy response needs to be credibly symmetric. The authorities need to be willing and able to reduce aggregate risk-taking and leverage during booms and increase it in times of stress. We should keep in mind that the policy response post-2008 was very strongly pro-cyclical. So the increasing bank capital and everything we've done to make the system safe is by definition pro-cyclical. Now, connect this to real estate. Changes in real estate prices affect both individual and public welfare considerably. And of course, we have very high degrees of leverage, both by individuals borrowing and then amplified by the institutions supplying the funds. So again, leverage on leverage, if you will. And that means we get pro-cyclical leverage cycles up and down. This is coupled with the fact that real estate tends to be sticky on the way down, not so much on the way up. Supply is very difficult, and both because of supply of land is limited and by zoning laws that limit supply as well. Then we plug that into government policies that tend to promote ownership. And of course, governments, they benefit from temporary booms of construction. So you almost get the same point as you get with interest rates, right? The real estate bubbles are something that the political leadership likes. And then we get large regional differences, which you don't get in monetary policy. One part of the country is in a boom, in a real estate boom, the other is not in a boom. And how do you target that across one single country? And then we might connect this to bank capital charges that favor mortgages. In Europe, of course, this is difficult. MacroPru is a national domain, perhaps implemented by a central bank that is no longer benefit from the credibility of monetary policy. So therefore, because the fundamental credibility of a central bank comes from efficient execution of monetary policy. When you decouple that, the central bank loses legitimacy. We have a high degree of democracy, but a very varying degrees of faith in government, which then limits the ability to execute difficult policies. Now, should we, when we get to MacroPru real estate, as some of the speakers will talk about later on, should we keep the tools fixed or adjust dynamically? Set the loan-to-value ratio at 8% or let it vary across the cycle? If it's dynamic, how will the policy authority deal with pro-cyclicality? How will it deal with the price level? And I think Thomas said it excellently in the beginning. The governments might proclaim they don't care about prices, but of course you can't do this without having prices in mind. And just as a thought experiment, suppose China had decided that it was on a bubble in 1995 and decided to clamp down on growth. China would not be there today. You don't really know at the time of a bubble, real estate or otherwise, if it's a bubble or not, until after the event. And like I said, China chose not to recognize it as a bubble, And that is one reason why it got the extraordinary growth it got since. So I think we should keep China in mind in this context. It's easy to focus on the potential for costs from real estate crisis, but there are also considerable benefits from high prices. High prices of real estate, they provide savings for individuals, vehicles of savings. They provide insurance, including pensions, and including old age care, which is now increasingly important in the UK. So high prices are of benefits. It creates capital for small and medium-sized enterprises, especially in lesser developed countries. It's a considerable source of taxes to governments and a considerable source of economic growth. So we cannot just say high prices are a bad thing. They also bring considerable benefit, and that complicates the policy making. And of course, high prices in real estate, they might be consequences of something more fundamental. Perhaps the very low interest rates that we have at the moment that's a key driver for prices rising. At the same time, low interest rates means that savings are a very unattractive alternative, and that directs money directly into prices. And prices rise in areas where the economy is strong because they attract people who then can pay more. So if one is concerned about a real estate bubble, does one want to look at the price rises, or should you be concerned about the underlying causes? I think all of these things need to be thought about sort of in together or in equilibrium for the policy making to make sense. And just to allow me to conclude, real estate bubbles certainly lead to financial crisis. We have a large number of cases in history where that happens, and I'm sure we will have many cases in the future. And real estate is certainly a very fundamental macroprudential concern. And I think this conference by the Bank of Lithuania is extraordinarily well timed, because this is perhaps one of the major concerns we have today. And therefore I'm looking very much forward to seeing what the speakers have to say on this. Do tools like loan-to-value ratios, debt service to income, or loan-to-income ratios, do they target the underlying cause or only consequences of other conditions in the economy and other areas of policy making? Is that what you should be targeting, or should you target the underlying causes? Is it possible for the tools you use to become pro-cyclical because they are either they're implemented out of cycle or not? Or how can we deal with issues of the politics of Macro-Pru real estate policy making and the legitimacy of the policy authority implementing it? And then if we start dampening out the cycle or targeting prices, then how does that fit into the question of the benefits of high prices to society? Now, these are all questions I find interesting. I don't have a good answer for, but I'm hoping the many speakers we have for the next 2 days will get into some of them. And I think with that, I will conclude my keynote address. But you're not completely done with me, because I am the chairman of the next session. So I actually...
Yes, indeed, this is the case. And thank you for your insights. Oh, mic is working. Thank you for your insights, and indeed, we're starting the first session. And I invite all the panelists to join me here. So you might start coming. And at the same time, I leave for the chair, for you to introduce the speakers of your panel. And some of you actually wondered why the title of session 1 and session 3 are exactly the same. No, this is not a mistake. It was intentional. And the idea is that these are session 1 and session 3 are policy panels, and the idea was to pose exactly the same questions so that we could hear views on this very interesting topic from a larger number of people. So I see nobody's coming. Where are your panel members? Yes, please. So
we had some discussion about this, and there was some preference for the panel members being able to watch the speaker while.
Okay, you're welcome. You are the chair.
That's what came across from them. So I think the plan of attack is that We will ask the three speakers to come up. Each of them will give a 20-minute presentation. I'll act as a timekeeper, hold up signs to tell you to stop if you go over 20 minutes. After 20 minutes, we will all take a seat here, and we'll have some discussion among the panelists, and then we'll take questions from the audience.